Good afternoon, everyone. It's my pleasure to be here again with you in our lovely module, Management, Accounting, Decision Making, and Control. So, in today's lecture, we will discuss the pricing decision that we have started last lecture. So today we will discuss how the companies make the pricing decision. And as you know, we have different pricing approach. Last lecture we have discussed the cost plus pricing, and today you will understand how to use the target pricing approach. So before we start our lecture today, I'm gonna do a quick recap of what we have discussed last lecture. So last lecture we discussed three major influences on pricing decisions. Do anyone remember them? Amazing. John is correct. Perfect. So we have three factors that impact the pricing decision: the competitors, the customers, and the costs. For the competitors, if you are in a monopoly, you might increase the price as much as you would like. But if you have an intensive competition in the market, so you might lower the price. Like in the food industry, you have a lot of competitors, so it's somehow cheaper compared to other products. But if you look at the IT technology, the very innovative products, you might find a higher prices if the company launch a new innovative IT product. So you will look at the competitors as well. The second factor was the customers. So the price usually is depend on the demand and the supply. So if the demand of the customer is really high, you might increase the price because the customer really would like to get your product. This depends on the quality of the product, the availability of the product, and the substitutability of the product. So if the customer can find a substitute with a lower price, then they will go. So if you go shopping, you like clothes and you're gonna go shopping tomorrow, you find when you go to the first shop, you find it's really expensive. But if you go to the shop next to it, you find it cheaper. So you go for the cheaper substitute, or you find higher quality, so you go for the higher quality substitute. We have also another factor that determines the price of the product, which is the cost. So if the product could be produced at a lower cost, then you as a company could produce as much as you can, and you could have a control of your price because you have a lower cost. But if the cost of the product is really high, that would limit the price variability of your product. Okay, last lecture we also discussed the price products using the cost plus approach, and today we will discuss a different approach, which is the target price. So target price is an estimated price for a product or service that the potential customer will be willing to pay. Let's take a practical example. So if we're gonna price using a cost plus approach. What does this mean? Simply, I'm gonna produce a trousers. The cost of it is £2, and as a company, I would like to get a profit, which is £3. Then cost plus targeted profit would be a £5. Then that's the price that you would like to sell the trousers for the customer. So today it's a different approach. It's called a target price. So what happened here? Very simple. The company make a marketing survey, go to the marketing, go to the customer, search the internet to get an estimated selling price. So let's say I'm selling a mobile phones, and this mobile is a new technology, and I have did my marketing survey. So the targeted selling price, the customer would like to get this product for £1,000. Okay, and me as a company, okay, I would like a target profit, let's say 200. Then 1,000 minus 200. So my target cost would be £800. So you have to ask your engineers to do something called value engineering to produce the mobile phone with this new technology, innovative technology, within the £800, no more. So that's the target price. So you start with a target estimated price according to the market, deduct of this price a target operating income, then you're gonna reach a target cost per the unit. We have a certain steps in developing a target prices and target cost. First, develop a product that satisfies the needs of the potential customers. So let's say we are in a high technology environment and my company is high tech and they're producing mobile phones. Then ask the customers, survey the market, what is the estimated price, and then derive the target cost by the equation. If you remember, target price minus target profit equal to target cost. Ask your lovely engineers to develop methods to achieve this cost. Okay? We have a question, we have a case. We're gonna be divided into two groups. Group A gonna be Mark, Sarah, and John. Group B gonna be Ahmad, Laila, and Michael. So Group A and Group B, each group of you gonna solve the case independently. So the case is about the target cost. So we have here John, management wants a 15% target operating income on sales, and the target sales revenue is 750. So that's the selling price of the product. What is the target cost? You have 5 minutes to answer this case within your group. Thank you. Okay, brilliant. So Group A and Group B, many thanks for your answers. It's really perfect. So what happened here? We have a target price, an estimated price, which is 750, and the company asks you as a management accountant to generate a profit 112.5. Then the target cost will be the target price minus the target operating income would equal to the target cost. Then simply the accountant will give this information, will provide it to the engineers to ask them to provide a product within this cost not to exceed 637. Perfect answers. Thank you so much. So today we have learned, we have understand how the companies make pricing decision. We have also solved a case about the target pricing approach, and remember that usually the companies determine the correct approach, whether it's a cost plus or target pricing, based on a certain strategy. The most common one is price skimming or penetration price. Price skimming, when you have a very elite product, an innovative product, you are the first to launch, like Apple. When you go to the Apple store, they have an innovative technology. That's why their prices tend to be higher than compared to the market. The other approach of pricing would be a penetration pricing. So let's see let's get an example of Primark. So Primark produce a lot of product which is cheaper than compared to the market. So they can penetrate the market with a low price product. So we have different strategies according to which the companies could do that. We have learned how to apply target pricing. We have learned how to apply cost pricing, and the management of the company would ask you as a management accountant to provide them with this useful information. Any questions? Amazing, lovely. So next lecture we will discuss a transfer pricing, very interesting topic, very important. Feel free to contact me, drop me an email, or you are most welcome to come visit me at the office. Thank you so much. I'll see you next week.